Hello everyone, we are from Group 13. We present Chapter 14 about central banks for money and banking. We will start the presentation with question 12.
For question 12, people in general welcome action that maintain effective communication and promote transparency, in particular when this involve public or semi-public institution. Can you think of a reason why a more transparent communication strategy might be detrimental to a central bank's objective? Firstly, market overreaction. Speculative or tentative information might trigger sharp asset price movement or shift in expectation that aren't aligned with actual economic condition, which is creating volatility. Secondly, reduced policy flexibility. Explicit forward guidance could constrain the central bank's ability to adjust policies as conditions change, since deviating from previous statement may damage its credibility. Thirdly, public fear amplification. Transparency about risks or uncertainties, like potential economic downturn, might exacerbate public fears, causing adverse behaviors such as reduced spending, hoarding, or premature sell-off. Lastly, challenges to stability. Excessive detail in projections or internal debates might confuse or alarm the public and financial markets, complicating the central bank's goal of fostering economic stability.
For question 14, the answer is William might argue that the extent of independence of the European Central Bank may lead to the inability of its policy to reflect economic needs at the level of member states. Its narrow focus on price stability, for instance, may easily elevate low inflation above other serious issues such as unemployment or divergence in growth among the members. This rigidity might also exacerbate economic inequality because less competitive economy, in particular, may not be able to recover without flexibility in monetary policy to fit their unique circumstance. Secondly, the lack of direct accountability to democratic institutions means decisions taken by the ECB can sometimes reflect the priorities of financial elites rather than the broader population, reducing public trust in the institution. Therefore, greater oversight or coordination with elected bodies may be required to ensure monetary policy works in the collective interest of all member nations.
Question 15 discusses the argument supporting the growing trend towards central bank independence. Central bank independence plays a crucial role in maintaining economic stability and public trust. First, it ensures effective monetary policy by enhancing credibility and stability, as decisions are made without political pressure. It also addresses the time inconsistency problem by focusing on long-term economic stability rather than short-term political gains. Second, during financial crisis, independence allows for swift and decisive action, free from political constraint, with decisions guided by technical expertise and robust economic data. Third, it avoids political interference by ensuring neutrality, keeping decisions free from political agendas, and building public trust in financial markets. Finally, we see strong global examples of success in countries include the Federal Reserve in the United States and the European Central Bank, which demonstrate how independence leads to consistent and effective policies. In summary, central bank independence is essential for credible policy, effective crisis management, and sustainable economic growth, while fostering trust and neutrality.
Hello, I'm Nurul Izatul and I will continue the presentation with question 17. The problem updates with real-time data in MyLab Economics and are available for practice or instructor assignment. So here's the situation. Go to the St. Louis Federal Reserve rate database and find data on the federal funds rate target and the discount or primary credit rate. When was the last time the federal fund rate target was changed? When was the last time the primary credit rate was changed? And did the rates increase or decrease? So now I'm going to answer the question about when was the last time the federal funds rate target was changed. So the answer is in December 2024, the Federal Reserve lowered the federal funds target rate by 0.25 percentage points, setting the new range between 4.25% and 4.50%.
Hi, I'm Clarissa and I'll be presenting when was the last time the primary credit rate was changed. So, according to the St. Louis Federal Reserve Rate Database, primary credit rate (TP credit) as of 17 December 2024 is at 4.75%, and primary credit rate (TP credit) as of 3 January 2025 is 4.50%. Regarding the primary credit rate, which is the interest rate charged to commercial bank and other depository institutions on loan they receive from their regional Federal Reserve Bank's lending facility. The most recent change also took place in December 2024. The Federal Reserve reduced the primary credit rate by 0.25 percentage points, aligning with the decrease in the federal fund target rate. This adjustment is part of the Federal Reserve's broader monetary policy strategy to influence overall economic conditions. These rate changes are significant as they influence borrowing costs for consumers and businesses, impacting economic activity. Lower rates generally aim to stimulate economic growth by making borrowing more affordable, while higher rates are used to cool down an overheating economy and control inflation.
Hello, my name is Salvi Danella Rogisin and I will continue to present question number 17, which is did the rates increase or decrease? So to answer this question, we'll start with the federal funds rate target, which consists of two components, the upper limit and the lower limits. For the upper limit, it decreased from 4.75% to 4.50%, while for the lower limit, it fell from 4.50% to 4.25%. This decrease is visually evident for the lower limit, where the step down happened between December 17, as shown in the figure 2, and 3 January in figure 3. Next, the primary credit rate was also reduced by 0.25% points on December 17, aligning with the change in the federal funds rate target. This downward adjustment signals the Federal Reserve's intention to make borrowing cheaper and stimulate economic activity. They encourage business to invest, consumer to spend, and help support economic growth during times of uncertainty. So, to sum up, both the federal funds rate target and the primary credit rate decrease.